All right, welcome. Today we're going to dive into something really crucial, corporate performance. But we're not just going to look at the big, flashy profit numbers you see in the headlines. No, we're going to peel back the layers to find out what's really going on inside a company. Let's kick things off with a question you've probably asked yourself 100 times. So imagine you see a headline. A company just posted $1 billion in profit. What's your first reaction? Probably something like, wow, that's a great investment, right? But is it really that simple? Well, as we're about to find out, that one big number can be, frankly, incredibly misleading. And that brings us to the really big question here. Is profit the whole story? The short answer? Absolutely not. That single bottom line profit figure, well, it can hide all sorts of things, good and bad. Think of it like an average that smooths over all the really important details. So check this out. It really breaks down the two worlds of analysis. On one side, you've got your classic financial numbers. Revenue growth, profit margins, the stuff everyone looks at. But the really savvy analysts, they look at the other side too. The non-financial stuff, like are customers actually happy? Is the brand something people trust? Are the best employees leaving? These things are massive clues about a company's long-term health. I mean, think about it. A company could report a massive profit this year just because they sold off a building. But at the same time, their main business, the thing they actually do, could be totally failing. That's a perfect example of how a big, shiny profit number can hide some really serious problems. So, yeah, we need to dig deeper.
Okay, so our first tool for digging deeper is a really important concept called the quality of earnings. Honestly, this is one of those ideas that truly separates the pros from the amateurs when you're looking at a company's financials.
So what is it? Well, to put it simply, the quality of earnings is all about figuring out how real and sustainable a company's profits are. Are they the kind of profits they can make again and again? High-quality earnings come from the company's main business. Low-quality earnings, they might come from one-time events, or, and this is where you have to be careful, from some creative accounting choices.
And this is exactly how it works. See, management doesn't just count the money that comes in. They make choices. They decide on their accounting policies, like how quickly to depreciate an asset. And every single one of those choices changes how their expenses get recorded, which, you guessed it, directly changes the final profit number they show us. And this is the key takeaway, right here. Accounting rules aren't always black and white. They have gray areas. And those judgments can be used to make things look a little better than they actually are. So our job, your job, isn't just to read the profit number. It's to be a detective, to see through all that noise.
Okay, so if that bottom line number is so noisy and potentially misleading, how in the world do we get a clearer picture? Well, that brings us to the main event, the big solution: unlocking corporate segments. This, right here, is the key.
I want you to think of most company reports like a locked black box. On the outside, there's just one big label, consolidated profit. And inside that box, everything is jumbled together. The good parts, the bad parts, the winners, the losers, all mixed up and totally hidden from view. But what if we had the key to that box? What if we could just open it up and see exactly what's going on inside? Well, turns out we do. That key is an accounting standard called IFRS 8 for operating segments. And what this rule does is it forces big companies to break down their results. They have to show us how their different business units or segments are performing. This is our ticket inside that black box. And what's so powerful about this is that it doesn't just give us any old view inside the company. No, it gives us the view, the one from the very top. Let me show you what I mean. See, the real magic of IFRS 8 is that it makes companies report their segments in the exact same way that the boss sees the business, the Chief Operating Decision Maker, or CODM as it's called. And that's almost always the CEO or the top executive team. So we literally get to see the business through their eyes. We can pinpoint which parts are growing like crazy and which ones are struggling. We can see where management is putting its money and placing its bets for the future. It's like we're getting a peek at the company's internal report card. For an outsider, that is an unbelievably powerful advantage. So, why do we go to all this trouble? Well, it all comes down to one thing: getting better at predicting the future. Because, let's be honest, understanding what happened yesterday is only really useful if it helps us make a better guess about what's going to happen tomorrow. Okay, let's make this real with a quick example. Take a look at Hypothetical Corp here.
If you just look at the total consolidated profit, it's $150 million. Sounds pretty good, right? But the moment we unlock the segments, a completely different story emerges. The cloud services division, it's an absolute powerhouse, pulling in a 40% profit margin. Meanwhile, the legacy retail part is actually losing money. And this chart, this makes the story pop even more. Now we're looking at growth. And wow, just look at that. Cloud services is exploding, growing at 30%. Tech hardware is kinda just chugging along, but legacy retail, it's going backwards. The future of this company is so clearly in the cloud, not in its old retail stores.
So now, armed with this amazing insight, you can build a so much more accurate forecast. Instead of just taking the total profit and guessing what it'll be next year, you can focus your predictions on that high-growth cloud segment, and you can be way more cautious about the part that's shrinking. All of a sudden, your model for predicting future cash flows is 10 times more sophisticated.
So let's bring it all back to you as the investor. You've now seen the internal report card. You know exactly where the growth engine is, and you know which part is dragging the whole company down. So the question is, if you were in charge, where would you invest the next dollar? When you look beyond that simple bottom line, the answer becomes crystal clear, doesn't it?